Hi, my name is Joseph and I will be analyzing accounts receivables. What are accounts receivables? An accounts receivable is an amount owed by a customer who has purchased the company's products through credit. Why do businesses analyze accounts receivables? Accounts receivables is uncollected income and is therefore a key predictor of future cash flows. It helps to evaluate how effectively the business manages its resources. It is also a key predictor of the effectiveness of the company's credit policy. There are many ways of analyzing accounts receivables. To demonstrate, let's take Woolworths as an example. One method is horizontal analysis. Horizontal analysis measures the change in accounts receivables between 2 years. It calculates the dollar change in an account balance as well as the percentage change. The formula for the dollar change in account balance is given by the current year balance minus the prior year balance, while the percentage change in account balance takes the dollar change value from the previous equation, which is divided by the prior year balance. Let's apply this to Woolworths. To calculate the dollar change, we need to minus the current year balance of 744.7 from the prior year balance of 763.9, which yields negative 19.2 million. We then take this value and divide it by the prior year balance of 763.9, then multiply this by 100 to obtain a negative 2.51% change. Another method is vertical analysis. Vertical analysis divides the account balance by a base account, resulting in a percentage of the total account. For the balance sheet, the formula is equal to the account balance divided by the base account, which is total assets. For the income statement, it is account balance divided by the net sales or revenue. If you apply this to Woolworths, the accounts receivable balance of 744.7 is divided by total assets of 22,915.8 million. This gives you 3.25%. For the income statement, the same accounts receivable balance is instead divided by total revenue of 55,475 million, totaling 1.34%. The next method is the receivables turnover ratio. The receivables turnover ratio is a comparison of credit sales to receivables that measures a company's ability to generate and collect receivables. The formula for this is credit sales divided by average receivables. The days in receivables ratio is a conversion of the receivables turnover ratio into days. It is calculated by dividing 365 into the receivables turnover ratio. In Woolworth's case, when substituted in the formula, it can be seen that on average the company was able to generate and collect receivables 74 times during the year, while taking about 5 days between selling an item and collecting the receivable. The final method is the allowance ratio. The allowance ratio is given by the allowance for doubtful debts divided by gross receivables and is used to determine the percentage of receivables that are expected to be uncollectible in the future. Let's apply this to Woolworths. The allowance for doubtful debts is equal to 34.1 million, and this is divided by gross receivables totaling 778.8 million, and then multiply by 100 to obtain an allowance ratio of 4.4%. Thank you for watching.